What's going on, Investomaniacs? Knight Rider here, and today we're taking a look at GM, GE, and Mickey D's, all reporting their most recent quarter day or two ago. So first, we're going to take a look at GM. They were expected to bring in $1.10 earnings per share on an adjusted non-GAAP basis. They delivered $1.41, a hefty beat, but that was still a 1.4% decrease from a year ago. Revenues missed. That was expected to come in at $35.8 billion. GM delivered $34.9 billion, down 3.4% year over year. You can see the stock did result not so well, down 2.65%, and today we're down an additional 0.5%. Net income was at $2.1 billion. This is a massive improvement of 93.2% year over year. Wholesale units sold, so the cars, trucks, everything that we're selling, the wholesale units sold decreased to 1.1 million from 1.16 million a year ago, and worldwide retail units sold decreased to 1.88 million from 2.1 million a year ago. That's a significant 10.5% decrease. GM's worldwide market share decreased from 10.6% from 11.4% a year ago. GM's North America segment saw sales of $27.4 billion, down from $27.8 billion a year ago. GM International's segment saw sales of $3.9 billion, down from $4.8 billion a year ago. That's an 18.8% shrinkage in revenue. That was in part due to some significant weakness in China. Cash and cash equivalents sat at $17.2 billion, a decrease from the $20.8 billion it had a year ago. So should you buy GM? If you're looking for a large, safe, and stable dividend, GM is currently yielding over 4%, so that's good. However, if you are looking for capital appreciation in terms of the stock itself, I would not recommend GM. Now let's take a look at GE. GE has been performing poorly the past few years, where we've lost, roughly 2/3 of our value the past 2.5-3 years. GE is trying to turn itself around, and GE did a relatively a good enough job with its most recent quarter. That's Q1 under new CEO Larry Culp. So adjusted non-GAAP earnings came in at 14 cents per share, beating the estimate of 9 cents per share. However, that was still down from a year ago, with 15 cents in earnings per share a year ago. Revenue was also down 2% year over year to $27.3 billion, but this is primarily due to additional asset sales. This has helped raise cash as well as make GE more efficient, and it's generally considered a positive. Organic revenue for GE's industrial businesses has increased 5% year over year. You can see the stock did react positively, and we're up about 4.5%. And then the following 2 days, we're going roughly sideways. You can also see they did announce the biopharma sale of $20 billion plus in cash proceeds, and that's going to hopefully be closing later this year. So that's an example of, they're obviously not getting the revenue from that anymore, but it's good that we're getting a lot more cash on the balance sheet. Adjusted free cash flow sat at a negative $1.2 billion, an improvement from the negative $1.7 billion a year ago. Industrial orders increased 1% to $26.2 billion, largely thanks to GE's strong aviation segment. GE experienced margin contraction in its industrial, power, and aviation segments due to various challenges and expenses. I like what CEO Larry Culp has been doing, and if you're willing to take on some risk and stay on top of the news coming out on this stock, I do think GE is a buy. Last but not least, let's take a look at the Golden Arches, the OG of fast food. That's Mickey D's. McDonald's Q1 earnings per share was expected to come in at $1.73. McDonald's surpassed those estimates, coming in at $1.78. However, this was still a small decline from a year ago earnings of $1.79. cents. It should be noted McDonald's claimed foreign currency translation had a negative result of 9 cents per share. So if you back out the currency variations, McDonald's would have seen a nearly 5% earnings growth. Revenue was expected to come in at $4.91 billion. McDonald's beat with $4.96 billion, but again, this was still down 4% from revenues a year ago. However, again, on a constant currency basis, so you're backing out the foreign currency translation, revenues would have been up 2% year over year. The stock did not perform so well. We're down about 1.73%. More on that later. The company-operated restaurants saw a 12% revenue decrease year over year to $2.2 billion, while franchise-operated restaurants increased revenues 4% year over year to $2.7 billion. Worldwide same-store comps improved by a strong 5.4%. Domestic same-store comps improved 4.5%. This was the 15th quarter in a row with positive same-store comps. Those are some pretty strong comps for something as established as McDonald's. So you did have the, was this a bad quarter? No, it wasn't a bad quarter, but McDonald's had ran up 18% over that past year. That was probably getting a little bit heated. So I think we're just getting a little bit of a correction now, and I think you're getting a little bit better of an opportunity of a price point to get in to McDonald's, where you are receiving a 2.44% dividend. It's a strong company. I think it's a buy. Hope you guys have a great day.